Spring and Vital Knowledge founder Adam Crisafulli and Evercore ISI head of internet research Mark Mahaney. Mark, I'm going to go to you first. You've been bullish on Netflix for a while. The fact that we're seeing 9.33 million net ads, which is more than double what the street had been expecting. Your thoughts?
Well, this stock is always going to trade off subs. I know the company would like not to hear that, but it is. And these subs were the sub performance was really impressive. So, we're going to look for the guide. We're going to look for commentary on the call as to what's the source of the upside. Is it the core business? Is it paid sharing? Or is it the ads, new ads business? And our strong guess is it's all three. You also have the pricing actions that are taking place. I mean, they're accelerating sub ads when they're taking up pricing. Very few businesses, consumer businesses, can do that. So it's kind of hard not to be bullish on this. Now, it's had a big run. Valuation is getting pretty full on this, but I think the stock continues to rise. If you can put up sub numbers like this and expand margins, that's good. You want to stick with a fundamental winner like that. Yeah,
and of course, we're seeing shares move higher as investors digest this report. Adam, I mean, this is sort of the unofficial kickoff of tech earnings season when we get this report. What does it signal here? How does it set the stage, especially on a day where, once again, we saw the market try to rally in the regular session and basically pair those gains, but we did close closer to the flat line than we were trading just a short while ago.
It was a failed rally, but also a failed sell-off at the end. So, it was almost a neutral sort of day. On the surface, the sub numbers look terrific for Netflix. I think, like Mark said, it will be interesting to kind of parse out how much of this is the end of password sharing crackdown, and then plus advertising, how much advertising is really ramping, if that's weighing on ARPU at all as the ad tier becomes a larger percent of the mix. I will point out we had two really important tech reports out this week, probably the two most important tech companies on the planet at the moment, with ASML and Taiwan Semi, and I think that really played into a lot of the weakness that you've seen in the market the last couple of days, where a lot of people were really counting on tech to act as a continued source of stability in the market. You had two of those names with pretty underwhelming results. So I think tech investors right now are quite anxious about the rest of the Q1 season over the coming couple of weeks. But for Netflix, it looks strong on the surface, but going through the full letter will be important.
Yeah, Mark Mahaney, speaking of the full letter, first of all, it's interesting. The stock is chopping around quite a bit in overtime, positive, negative. You talked about the valuation being full. Here, Netflix is forecasting for Q2 revenue growth of 16%, and for the full year revenue growth of 13 to 15%. And operating margin of 25%. They're kind of emphasizing the cash flow and stability in cash flow that comes from this engagement. Is that good enough to put new money to work, you think, in Netflix? Or is this just along the lines of what investors were expecting, bidding it up as strong as it's been over the past 12 months already?
It's not too far off from what investors were thinking, but the paid sub growth is really what matters more than anything else, as long as that doesn't come at the expense of margins, which the print and the forecast suggest is not the case. Then we're going to be listening for kind of these longer term initiatives. And the two that are kind of at the high top of our list are gaming and more quasi and then real live sports on the Netflix network. But in the meantime, I think people underappreciate the power, not just the paid sharing, but really the ad-supported business. That's what really changed our mind on this about 2 years ago. This is the number one pain point this company had. The prices were too high. They addressed that challenge, and then it turns out they can do this economically because plenty of other streaming companies, were able to generate good ad revenue on these save ad models, subscription and advertising, video on demand businesses. So Netflix is right there in them and with them, and it can probably do better than that. So it's the free cash flow inflection is there. The industry is consolidating. Competitive risk is declining. It'll rise again at some point, but right now it's declining. And so I think the call is still bullish on Netflix. But this is not a dislocated stock, so it's not one of our top picks. But it's still a solid buy for us.